Topic 11. Accounting for equity. Learning objectives. 11.1. Definition of equity. A. Explain the term of equity. 11.2. Statement of changes in equity. A. Identify items to be presented in the statement of changes in equity. B. Compare the items of equity in different business ownership. 1. Sole proprietorship. 2. Partnership. 3. Company. 11.3. Presentation of equity in the statement of changes in equity. A. Show the presentation of changes in equity in the statement of financial position. 1. Sole proprietorship. 2. Partnership. 3. Company. What is owner's equity? Owner's equity is essentially the owner's rights to the assets of the business. It's what's left over for the owner after you have subtracted all the liabilities from the assets. If you look at your company's statement of financial position, it follows a basic accounting equation. Assets minus liabilities equals owner's equity. The term, owner's equity, is typically used for a sole proprietorship. Owner's equity is the owner's right to the assets of the business after all liabilities have been paid. For a proprietorship, the owner's equity is represented by the balance of the owner's capital account. A drawing account represents the amount of withdrawals made by the owner. The ownership claim on total assets is owner's equity. It is equal to total assets minus total liabilities. Here is why. The assets of a business are claimed by either creditors or owners. To find out what belongs to owners, we subtract the creditors' claims, the liabilities, from assets. The remainder is the owner's claim on the assets, minus the owner's equity. Since the claims of creditors must be paid before ownership claims, owner's equity is often referred to as residual equity. What is included in owner's equity? Owner's equity includes 1. Money invested by the owner of the business. 2. Plus profits of the business since its inception. 3. Minus money taken out of the business by the owner. 4. Minus money owed to others. Is owner's equity an asset? Business owners may think of owner's equity as an asset, but it's not. Shown as an asset on the statement of financial position of the company.
Why?
Because technically owner's equity is an asset of the business. Owner, not the business itself. Business assets are items of value owned by the company. Owner's equity is more like a liability to the business. It represents the owner's claims to what would be left over if the business sold all of its assets and paid off its debts. Can owner's equity be negative? Owner's equity can be negative if the business liabilities are greater than its assets. In this case, the owner may need to invest additional money to cover the shortfall. When a company has negative owner's equity and the owner takes draws from the company, those draws may be taxable as capital gains on the owner's tax return. For that reason, business owners should monitor their capital accounts and try not to take money from the company, unless their capital account has a positive balance. What is a statement of owner's equity? Some financial statements include a statement of owner's equity. This financial statement provides details about the changes to the owner's capital account over a certain period, such as 1. The opening balance of the owner's capital account. 2. Increases to equity from profits or additional capital contributions. 3. Decreases to equity from losses or capital distributions. 4. The closing balance of the owner's capital account. The closing balances on the statement of owner's equity should match the equity accounts shown on the company's balance sheet for that accounting period. First, sole proprietorship. In a proprietorship, owners' investments and revenues increase owners' equity. A. Investment by owner. Investments by owner are the assets the owner puts into the business. These investments increase owners' equity. They are recorded in a category called owner's capital. Revenues. Revenues are the gross increase in owner's equity resulting from business activities entered into for the purpose of earning income. Generally, revenues result from selling merchandise, performing services, renting property, and lending money. Common sources of revenue are sales, fees, services, commissions, interest, dividends, royalties, and rent. Revenues usually result in an increase in asset. They may arise from different sources and have different names depending on the nature of the business. Taipei Pizza, for instance, has two categories of sales revenues: pizza sales and beverage sales. In a proprietorship, owner's drawings and expenses decrease owner's equity. B. Drawings. An owner may withdraw cash or other assets for personal use. We use a separate classification called drawings to determine the total withdrawals for each accounting period. Drawings decrease owner's equity. They are recorded in a category called owner's drawings. C. Expenses. Expenses are the cost of assets consumed or services used in the process of earning revenue. They are decreases in owner's equity that result from operating the business.
For example, Taipei Pizza recognizes the following expenses: cost of ingredients, meat flour, cheese, tomato paste, mushrooms, etc.
Cost of beverages. Salaries and wages expense. Utilities expense, electric, gas and water expense, delivery expense, gasoline, repairs, and licenses, supplies expense, napkins, detergents, and aprons, rent expense, interest expense, and property tax expense. Second, partnership. Partnership agreement. The written agreement can contain as much or as little as the partners want. The usual accounting contents are: 1. The capital to be contributed by each partner. 2. The ratio in which profits, or losses, are to be shared. 3. The rate of interest, if any, to be paid on capital before the profit shared. 4. The rate of interest, if any, to be charged on partners' drawings. 5. The salaries to be paid to partners. 6. The arrangements for the admission of new partners. Procedures to be carried out when a partner retires or dies.
A. Capital contributions.
Partners need not contribute equal amounts on capital. Matters is how much capital each partner agrees to contribute. They may increase the invested capital later. B. Profit, or loss, sharing ratios. Partners can agree to share profits or losses in any ratio or any way they wish. However, it is often they share in the same ratio as in which capital is contributed. C. Interest on capital. If the work to be done by each partner is of equal value but the capital contribution is unequal, it is reasonable to pay interest on the partners' capitals out of partnership profits. This interest is treated as a deduction prior to the calculation of profits and their distribution among the partners according to the profit sharing. D. Interest on drawings. To deter the partners from taking out cash unnecessarily, the concept can be used of charging the partners interest on each withdrawal, calculated from the date of withdrawal to the end of financial year. The amount charged to them helps to swell the profits divisible between the partner. E. Partnership salaries. One partner may have more responsibility or task than the others. As a reward, rather than change the profit and loss sharing ratio, the partner may have a partnership salary which is deducted before sharing the balance of profit. Third, company. The capital of the company is derived from shares invested by the shareholders of the company. The shareholders are the owners of the company. There are three types of shares that can be issued by a company, namely ordinary shares, preference shares and deferred shares. However, only ordinary shares and preference shares are offered to the public. The differences between the three shares are in terms of voting rights at the annual general meeting, preference to receive dividends and preference to recover capital when the company is dissolved. A. Preference shares. Preference shares are shares that have a dividend preference and recover capital if the company is dissolved, as opposed to ordinary shares. However, preference shareholders do not have the right to vote in the annual general meeting. The return earned by the shareholders is in the form of dividends. Dividends for preference shares are fixed at the rate stated on the par value of the shares. The dividend payment takes precedence over ordinary share dividends. However, the dividend paid also depends on the decision of the board of directors. This means dividends for preference shares are not necessarily issued annually. If the company is dissolved, the preference shareholders have priority to recover the contributed capital over ordinary shares. Therefore, preference stocks have a lower risk of losing their capital compared to ordinary shares. B. Ordinary share. Every company must have common share capital. Usually, ordinary share is the largest component of a company's capital. Ordinary shareholders are given the right to vote at the company's annual general meeting according to the shares they hold. This right allows a shareholder to influence decisions related to company policies as well as the appointment of members of the company's board of directors. Therefore, the ordinary shareholder is the owner of the company. Ordinary shareholders receive dividends after dividends are paid to preference shareholders. The dividend rate of ordinary shares is not fixed, and such dividend payments are not necessarily made annually. It depends on the decision of the company's board of directors. If the company is dissolved, the ordinary shareholders will get back the contributed capital after the preference shareholders get their capital. It is possible that they will not be able to fully receive the capital they contribute, or will not be able to do so directly. Therefore, the common shareholder is the risk holder of the company. Thanks for watching.